Hi, this is Professor Marsh, and welcome back to Principles of Financial Accounting. This will be Chapter 5, Unit 5, and we'll be talking about completing the accounting cycle. There are 4 learning objectives for you in your chapter, and those learning objectives are to describe and prepare the closing entries for a business. So how do we conclude one accounting period and get ready for the next one? That's basically what we're talking about there. We're going to prepare a post-closing trial balance. So you've seen a trial balance and you've seen an adjusted trial balance, and now we're going to take the adjusted trial balance, and we have to make sure that all of our closing entries keep the trial balance in balance. So our debits are going to equal our credits, and the equation of assets equal liabilities plus equity will be preserved in this process. So that's how we'll do it correctly. We're going to close out the revenue and expense accounts from the income statement and begin to do some financial analysis. And as part of that financial analysis, what we'll do is we'll take the results that we get from the adjusted trial balance, and we're going to compute the current ratio and the working capital balance and explain how these measures represent liquidity. And then in the appendix, which we'll probably do mostly in unit number 6, we're going to complete a comprehensive accounting cycle for a business. But we'll discuss the comprehensive accounting cycle and the preparation of the financial statements, and we'll dive into that more deeply in Unit 6. So the first 5 chapters of your book are basically the Pentateuch of accounting. Master these 5 chapters and you will have the competence to work in bookkeeping or accounting at any business. After the midterm, we will spend Unit 7 looking at accounting information systems, especially those that are used in most small businesses, and look more deeply at specific techniques for accounting for certain types of transactions and special assets and liabilities. So let's go on and look at describing and preparing the closing entries for a business. So what are closing entries? Well, closing entries prepare a business for the next period, and they zero out balances in the temporary accounts. Well, what are the temporary accounts? Well, let's take a look at that. The temporary accounts are the accounts that are basically the revenue and expense accounts, and then also the dividends account. So those accounts need to be zeroed out. But again, the purpose of the closing entries are necessary because they help the business review income accumulation during a period, and they verify the data figures found on the adjusted trial balance. And they set the income statement accounts back to 0 at the end of the period so that you're ready to track revenues and expenses for the next period. So permanent accounts do not close. Those are accounts that transfer balances to the next period. So those are the balance sheet accounts, assets, liabilities, and stockholders' equity. And the temporary accounts are ones that are closed at the end of each accounting period, and they include the income statement accounts for revenues and expenses, dividends, and the income summary account. And if you look at your turn in section 1.5, you're going to see a listing of the temporary and permanent accounts. And you see a schematic in figure 5.3, and then as you go down to below section 5.3, there's a a little gray box that says your turn permanent versus temporary accounts. And there's a list of various accounts, and they state whether each account is permanent or a temporary account. And I'm going to ask you to maybe cover up the solution and look at that and see if you're surprised by the results you get, because sometimes people are. What about unearned revenue and prepaid insurance? Why is it that unearned revenue and prepaid insurance are considered permanent accounts? As we looked at Unit 4, remember that we made adjusting entries to unearned revenue and prepaid insurance to reduce them by the amount of that was used currently. So, these, unearned revenue is a liability account, and so it's a credit balance is the normal balance for unearned revenue. And so the way that you close out, the adjusting entry that you make in the adjusting entries to unearned revenue is to reduce the unearned revenue to the amount of unearned revenue that's still unearned at the end of the period. And so that's a debit entry to that liability, and then you make the offsetting credit entry to revenue, to income, because you've earned it during that period. And then, the converse of that is prepaid insurance. Prepaid insurance is insurance that you've paid for but you haven't used yet. So maybe you paid a 1-year premium at the beginning of the year and you use 1 month of it during the period. And so you make an adjusting entry at the end of the period to reduce that asset account, and the normal balance in an asset account is a debit. So you credit the prepaid insurance to reduce it from 12 months worth down to 11 months worth, and then you make an offsetting debit entry to insurance expense for the period. So we did that last chapter in the adjusting entries. So whatever is left when you're making your closing entries in unearned revenue or in prepaid insurance has already been adjusted. So those are the balances in those liability and asset accounts that you're carrying into the next period. So that's why they're considered to be permanent. Now, it could be that your policy ends at the end of the, at the end of the period, and you haven't paid your premium for next month yet. So it could be the balance, in the prepaid insurance account goes down to 0 at the end of the period, if it just happens to line up that way. And it could be that the unearned revenue, maybe that you've earned all the revenue that you've for services or goods that you've, either performed or delivered. So there's no more unearned revenue, but they are considered to be permanent accounts. And then, of course, the revenue and expense accounts that you see on there are temporary accounts, and dividends is a special type of account that only affects shareholders' equity, and that's considered to be a temporary account too. We typically close that out with the final closing entry to retained earnings. So anyhow, that's an explanation of that. The income summary account is a temporary transitional account that we use to close out the income statement and to get everything back to 0 in revenues and expenses and get ready for the next period. And of course, revenue, expenses also includes gains and losses. So don't forget about gains and losses too. Those are temporary as well. And so you can see the journal entries. The book does a good job of using the example of our old friend Printing Plus. And so you start with the adjusted trial balance. That's in figure 5.4. And you can see that, the adjusted trial balance still has all of the balance sheet accounts listed first. And then you also see a dividends account after common stock. And then you see the revenue and expense accounts as well. And so you can see all that, and of course it's in balance, as all adjusted trial balances are supposed to be. And this gives you the example of the journal entries and the T account entries that are necessary to do your closing entries. And so the first closing entry is going to be to close out revenue accounts. So this would be revenue accounts, and if we had gains, it would also be gains accounts. And so when you have revenue, your revenue is typically, the normal balance is a credit balance, and so to close it out, you make offsetting debit balances. And you can see the two debit entries for interest revenue and service revenue, and in the T account you can see how that reduces those two accounts down to zero. And then you're setting up an income summary account, and that's a credit entry for revenue. And so you're taking the revenue off the books of the income statement now as you close out the books, and putting it into income summary. And so then you do the same thing or similar thing with the expenses, except since it is you're closing out the expense accounts, you're going to make an entry to income summary, which is a debit entry, and then you're going to use the credit entries to zero out the T accounts for the various expenses, the various categories of expenses. And so you can see the T account journal entry, the second one of your closing entries, is income summary is debited for $5,575, and then you see that the supplies expense is credited. That eliminates it brings an expense account down to zero as a credit entry reduces it. Depreciation expense, salaries expense, and utilities expense, and when you add up all those expenses, they equal $55.75. So our debits equal our credits, and you can see how that looks in the income summary account. And then when you look at the income summary account, you see the two entries there. You have the credit entry for $10,240 for the revenue, and the debit entry for $55.75, and that balances at $4,665. That's going to be your income for the period. And then you close out that income summary account with a debit entry to income summary and a credit entry to retained earnings. And so retained earnings, a credit entry increases retained earnings, and so it's increasing your retained earnings for the period by $4,665. That's your third closing entry for the period. And you can see how that looks. You've got the income summary account in the T account is now back down to zero, and retained earnings, this is the first period. It didn't have anything in it before because it's the first period, so now it's got a balance of $4,665. But that's not everything. That's not everything. You have one more item on your adjusted trial balance, and that is that the company, Printing Plus, paid a $100 dividend to the owner. And so that dividend also has to be zeroed out because dividends are a temporary account. And so you make an adjustment to retained earnings. It's debit entry because you're reducing retained earnings because you've paid out the dividend. And then you credit the dividends account, and that closes out the dividend account for the period. And then you can see there's a statement of retained earnings. So this is where you prepare your statement of retained earnings, which is one of your basic financial statements. And you can see how it's going to look for Printing Plus for their first period that ends January 31st, 2019. They started with zero. They had net income of $4,665, and then they paid a dividend of $100, and the ending retained earnings is $4,565, and that's in figure 5.6. And look at all the happy little T accounts that are down there in figure 5.7, and you can see that all the income and expense accounts have been zeroed out at the end of the period, as they should be, by our closing entries, and now the only accounts that have balances are the balance sheet accounts. And so we're ready for February of 2019, a nice fresh start. Now take a look at the Think It Through question toward the end of the period. A company has revenue of $48,000 and total expenses of $52,000. What would the third closing entry be? This is, see if you can figure this out. See if you really know your stuff here. So, company has revenue of $48,000 and total expenses of $52,000 for the period. What would their third closing entry be? Well, the third closing entry is where you close out the income summary account. And if you go up above and look at the example of Printing Plus, you'll see that they had income of $46.65 for the period, but this company has a loss. This company has a loss of $4,000, right? $48,000 in revenue, $52,000 in expenses. So how would you close out the income summary account when the balance is going to be negative, or is going to be a loss of $4,000? And so what you're going to have to do is you're going to have a credit entry for $4,000 to income summary, and then a debit to retained earnings of $4,000. Now, a debit entry in retained earnings reduces retained earnings, but you had a loss for the period, and so that's the correct entry. So the journal entry that you would make using the convention that we typically have debits before credits would be first a debit to retained earnings of $4,000 and then a credit entry to income summary of $4,000. Debits equal credits, right? So that would close out the income summary account for that company in the Think It Through example. Take a look also at the Frasker Corporation example and see if you can do the closing entries on this adjusted trial balance. Maybe cover up the solution and give it a try and see if you can get it correct. But that's another example. Just look at the adjusted trial balance. You can hopefully by now you can look at an adjusted trial balance and you can see, which are the balance sheet accounts that are going to be fine, and then which accounts need to be zeroed out. And you can see that Frasker Corporation paid a relatively high dividend in that period and earned a substantial amount of fees, which is revenue. Okay, fees earned is the equivalent of revenue. So just do a little thinking sometimes. If you don't see the word revenue in there, just think about where revenue is, and you can see a credit entry for fees earned. And oh, okay, Frasker Corporation earns fees, that's their revenue. And then they pay salaries, pretty puny salaries compared to the fees, a little bit of advertising, a little bit of rental expense, and some utility expense. But that sounds like a professional service company. But anyhow, you can see the now that you've tried to do it, you can take a look at the solution here, and you see the 4 closing entries. So that's it. You've known journal entries and you know T accounts, and you've been doing this now for 3 or 4 units. So this is just continuing it, and it's just basically telling you the procedure that we use. You're not really learning anything new. You're just applying what you've already learned about journal entries and T accounts. And then the next section, section 5.2, is to prepare a post-closing trial balance. And if you take a look at figure 5.8, you'll again see our old friend Printing Plus that has an adjusted trial balance for January 31st, 2019. So here we are again. What do you notice about it? Okay, this is the post-closing trial balance for Printing Plus. So I said adjusted trial balance, but I meant this is the post-closing trial balance. And what do you immediately notice about it is it's only balance sheet accounts. There's no income statement accounts. There's only permanent accounts, and you don't have the dividends account here either. This is the post-closing trial balance. And so no temporary accounts, only permanent accounts. Note that there is a concept called reversing entries. So reversing entries, we're going to skip that in this course, but you'll see them in intermediate financial accounting and other more advanced courses that will cover prior period adjustments. So we're not going to have that yet we'll get into making prior period adjustments if we take a more advanced accounting course in financial accounting. At this point, you see how the financial statements for a company work, how they interact, and how they're constructed. And this course is designed to help you not only learn the basics of accounting, but also to understand how to read and interpret financial statements as a manager, lender, or investor in a business or other entity. We're now going to learn a few of the most basic techniques of financial analysis. The analysis of financial statements is called financial analysis. That's reading financial statements and trying to figure out what's going on in a company. And this is what we're going to learn is the concept of working capital and the calculation of the current ratio. And that's going to be in section 3. So let's go into section 3 in chapter 5. And we're going to apply the results from the adjusted trial balance to compute the current ratio in working capital. And this section begins with a discussion of cash basis versus accrual basis accounting. And I want to talk to you about this a little bit. I actually put into your homework for the last unit, for unit 4, I put a link into the Khan Academy, and Sal Khan, who was an MBA from MIT. I mean, he's a pretty smart guy. And he actually does an explanation of cash versus accrual accounting that I thought would be very helpful to you, maybe even, better than I could do myself. So I gave you that link. And I also, I think, had a quiz question about that. So I hope you watched that and enjoyed it. But cash basis accounting is by far the more prevalent type of accounting, but we're learning accrual basis accounting in this course, okay? The cash basis system delays revenue and expense recognition until cash is collected, which can mislead investors about the daily operations of a business. This is what traditional accounting theory tells us. The accrual basis system recognizes revenues and expenses in the period in which they're earned or incurred, when revenue is earned or expenses are incurred, and it allows an even distribution of income and a more accurate picture of the business of daily operations. And if you look at Sal Khan's explanation of that, you can see that in the example over the 4 months of income and expenses that he discusses for that catering or events business that he's talking about. And don't think automatically, though, that accrual is always better than cash. And if you start a business, you definitely want to use accrual basis accounting because that's better. No, don't have that misunderstanding. I've seen clients start with that. Accrual accounting is more difficult for people to understand than cash basis accounting, and most people who are doing business with small businesses are going to expect to see cash basis accounting. So cash basis is by far the most prevalent. And the other thing about cash basis accounting that is helpful is that it's really helpful for tax purposes. Most people want to pay tax only based on when they collect their cash. And oftentimes working capital and collecting is a struggle for beginning small businesses. You have to get to be, a pretty big, significant business before you can kind of order people to pay in advance and do things like that. So a lot of times, a lot of small businesses are performing services and providing goods, financing them the best they can, and then trying to collect for that. And it's really difficult sometimes to collect accounts receivable for a brand new service business. It's a constant struggle in the accounting field and in law firms. You really have to have a discipline of trying to collect as you provide the service, because a lot of times clients are slow in paying. And certainly accounting firms, in most cases, when they do something on a monthly or quarterly or annual basis, like preparing a statement or a tax return or something like that, like to collect when they deliver the deliverable. So whatever statement or return that might be. So don't automatically think that cash basis is worse than accrual basis. It's just that for purposes of learning it as an academic discipline, we like to learn accrual basis accounting, and it certainly helps in analyzing larger companies and companies that are following GAAP. It helps in analyzing those types of financial statements. And so many times, if you get into the investment business, you're going to have to become very familiar with GAAP or with the international financial reporting standards to make sure that you understand how the financial statements were prepared. And most financial statements that you'll find from a company using GAAP are going to be classified balance sheets. And the classified balance sheet is a balance sheet that breaks down assets and liabilities into subcategories that focuses on current and long-term classifications. And that allows investors to look at the company's position in both short-term analysis. Do they have enough money? Do they have enough expectation of collections to keep going and pay their current obligations? And long-term, what is their long-term potential? Are they investing for the future, or are they piling on a lot of long-term debt that eventually they're going to have to pay for? Certainly, if you looked at the United States financial situation and our $30 trillion national debt, our long-term liabilities are looking pretty bad, even if our short-term collections, occasionally get better, as they did back in the late 1990s, where we actually had some surpluses for a few years. So the next concept that we're going to look at is liquidity. Liquidity is a concept that means that a business has enough cash available to pay bills as they come due. And being too liquid can mean that a company is not using its assets efficiently. Now, my first real job was to work in a bank as a bank teller. And the second year I worked for the bank, which was the mid 1970s, early 1970s, I guess about 1973, 74, I worked as the head teller for a bank that had 12 branches. And I was in the main branch. I was the head teller in the main branch, and I actually, I didn't have the combination or the keys to the vault, but I did have the combination and the keys to the safe inside the vault, where we kept the surplus cash that had to be delivered by our couriers out to the branches as they needed new cash, both circulated cash, cash that was still in circulation that was acceptable, and then also new money. Oftentimes banks like to have packets of brand new uncirculated money for certain customers who want to use nice crisp bills to make birthday or Christmas gifts, or just because they only like carrying around new money. And so we would send those out to the branches and circulate them among our tellers too. And like many young and inexperienced people who work in a bank, I was deathly afraid that we would run out of cash. And so as we ordered cash to come to us from the Federal Reserve, we would typically do that on a periodic basis, maybe every week, every month. We would order cash, and they would deliver the denominations that we needed from the local branch of the Federal Reserve System to us. And then we would also take the mutilated money, or what we called mutes. We would take those bills out of our drawer, and we would exchange those for acceptable bills. And we'd take all the ones that were scotch taped and damaged, maybe frayed, maybe torn apart a little bit. Those we would send those back to the Federal Reserve to be destroyed. And I was worried about running out of cash, so every time I would order money, it seems the amount of money that we had in the vault grew and grew and grew until it was far in excess of $1 million that I had in excess 20s and 10s and hundreds and 50s and 5s and 1s, to the point that the safe with the cash inside the vault was starting to overflow a little bit. And so eventually one of my superiors noticed that, and they forced me to send a bunch of money back to the Federal Reserve. And the point of the bank is that the bank made loans back then, and you know, back then it was a different time. I mean, $1 million was a lot more than it is today. In the mid-1970s, I think the average house was less than $30,000. So the average home, the average single-family home, could be purchased for less than $30,000. And so we've had a lot of inflation. It really kicked in high in the late 70s and early 80s, and of course it's kicking in again today. But back then, the bank would pay about 4% interest on savings accounts, and you know, this brand new interest on checking called the Now account, where they paid interest on the checking accounts, which was a new concept in the 1970s, probably brought on by inflation. But then the bank would charge 7 or 8% on loans, and so the bank made money on the spread between what they lent the money out at, the 8%, and the interest rate that they paid, either to the Federal Reserve, which back then the Fed rate was a few percent, or what they paid to customers, which, you know, the 4% that they paid on savings. So if I had, you know, $1 million in the safe, and we only needed, you know, say 200,000 in there to keep our branches happy and keep them, you know, with enough cash to cash checks for customers and that sort of thing, then that 800,000 they were losing 4% on. Well, 4% of 800,000 over the course of a year, you know, is a pretty large amount. That's $32,000 that I was costing the bank, which was a lot more than what they were paying me on an annual basis back then. That's for sure. And so that was more than the value of a house. So in any event, that was a mistake I made by being too liquid. And being too liquid, as the book points out, can mean that a company is not using its assets efficiently. So too much liquidity can be too much. Not enough liquidity, though, can put you out of business. Working capital shows how efficiently a company operates. The formula to calculate working capital is current assets minus current liabilities. But what's a current asset? Well, a current asset is one that is designed to be collected or converted into cash or used during one operating cycle or 1 year, whichever is longer. So examples of current assets are cash, accounts receivable, inventory, supplies, and you can see an example of the operating cycle in figure 5.10, and the book also presents additional examples of current assets. And then current liabilities are liabilities that are expected to be paid within that same period, so the operating cycle or a year, whichever is longer. And you can see that in figure 5.10, the operating cycle as well. Now, if you look at figure 5.11, you see a flow chart. This is a flow chart for how to classify an asset, and this is something which is taken, you know, by many. These types of flow charts are very common in accounting and auditing, as far as, you know, basically a decision tree that helps you classify what type of asset it is. So if it's cash, or an asset that will be converted to cash or used up within 1 year or the operating cycle, whichever is longer, reported as a current asset. Now, if not, is it a tangible asset that's being currently used to help generate revenue? If yes, then you report it as property, plant, and equipment. If no, it's not currently used to help generate revenue, is it a stock, bond, long-term investment that will be held for more than 1 year or the operating cycle, whichever is longer? If yes, you report it as a long-term investment. If no, then you report it as an intangible asset or perhaps an other asset. So that's basic asset classification. I have to tell you that many of my clients have marketable security investments that are reported as current assets on their financial statements, and correctly so, because they are immediately convertible to cash. And oftentimes when a bank asks you for a personal financial statement, on your personal financial statements, the stock, bonds, other marketable securities that you have are included in current assets. So don't be confused by that. This is really anticipating that the stock, bond, or other long-term investment that will be held for 1 year might be just an investment in another company, maybe in a subsidiary or an affiliate of the company that you're classifying. So think of it as maybe a non-marketable security, or something that is such a significant position in the other company that you're not expecting to sell it anytime soon. So Berkshire Hathaway oftentimes is a good example of a company that buys other companies but then allows them just to, so Geico Insurance, which is a subsidiary of Berkshire Hathaway, would be a long-term investment on the books of Berkshire Hathaway, even if individual shares in Geico could be sold on a securities market. Berkshire Hathaway's position in the company is so large that it's really just another long-term investment of Berkshire Hathaway. And if you've ever looked at Berkshire Hathaway's financial statements or read their annual report, you can see that as a holding company of other companies that Warren Buffett and Charlie Munger report their financial results a little differently than the typical company does, and they've been very successful at it over the years. Okay, so working capital, current assets minus current liabilities, and current ratio. The current ratio is current assets divided by current liabilities. And that shows how many times over a company can cover its short-term, immediate liabilities. And so both of these are measures of the liquidity of a business, and you can see examples of this. Now, in your materials, there is a link to a PricewaterhouseCoopers, and it still works. It's their report on 2015 liquidity, and you can see that report, and it, if you really want to take a good look at it and understand it, it's in the link to earnings that is after figure 5.13 that explains a lot of this stuff. But if you look at that, you could probably spend a half an hour or an hour just going through it. It's a very detailed study on working capital in actual companies back in 2015, and it's just really got a lot of information about how different companies manage their working capital, and a lot of these are some of the best run companies in the world. If you go back up above that and you look at figure 5.13, you'll see something that might be more useful for the homework here. And this is taking a look at the printing pluses. You've got their balance sheet, and you can see that this is not a classified balance sheet, so you have to do the classification yourself in figure 4.13. And working capital for them is going to be $25,540, and that is the sum of all of the assets except for the equipment and the accumulated depreciation contra account against the equipment. So it's going to be cash, accounts receivable, interest receivable, and supplies. Don't forget, supplies is considered to be a current or short-term asset. And then what are the current liabilities? And you've got accounts payable, salaries payable, and unearned revenue. All three of those are current liabilities. There's no long-term liabilities on this balance sheet for Printing Plus. And so you can see that their working capital is the $26,540 of current assets minus current liabilities of $5,400 or $21,140. And so there's more than enough working capital to pay the current liabilities. And then if you do the current ratio calculation, which is down below the PwC link, you can see that the current ratio is 4.91 times, which is a very healthy ratio, maybe too high, but since this is a brand new company, short-term company, it may have some cash still on the books that's going to be invested in the next few months. Typically, if you see, a working capital ratio of, 1.5 to 2 times current assets over current liabilities, and the book points this out, that's more than enough of a current ratio. And you can see that some very stable companies that have great cash flow, like, public utilities, that don't have a lot of seasonal, maybe not an oil distributor, which would have a very seasonal revenue history, but maybe a electric utility, would be able to keep a smaller current ratio of maybe 1.25 times to 1.5 times the current assets over current liabilities. Now, the way they write these ratios in the book bothers me. I don't like the way it's presented. When you have a ratio of let's look at Printing Plus's ratio. Okay, so 4.91 times. Okay, so 4.91 times, just the way I wrote this right here. Okay, that's an acceptable way of showing their current ratio. Okay, another acceptable way is to actually write it as a ratio. And so you can also write it as 4.91 with a colon to 1. It's 4.91 current assets to 1 current liability. Okay, how they do it in the book, I think they should be using a dash instead of a colon in some of those paragraphs there. So they mean 1.5 to 2 times, 1.25 to 1.5 times for the public utilities, or 2.5 to 3 times for a startup in high tech. But they shouldn't be using the colon there. They should be using a dash. And the way that you actually write the ratio is with the colon, or if you just want to keep it simple, 4.91 times current liabilities. And that's the correct way to write it. Don't follow what they have in the book on that. Okay, so that's it with the first 3 sections of this chapter, and the 4th section, the appendix, is completing a comprehensive accounting cycle for a business. That's the process in which the transactions are recorded in the accounting records and ultimately reflected in the ending period balances on the financial statements. And you pop out an income statement that records just the operations for the period, and then you zero it out into your balance sheet. You go on to the next period. And you can see that there's an example here for, what is it, Cliff, what is he, Cliff the Barber? Yeah, Clip 'em Cliff. And you can work through that and we will probably do a comprehensive accounting cycle as we get into Unit 6 and then also into the midterm. But just take a look at this now, learn this material, but don't expect to retain it until we actually do the examples in Unit 6, and then be ready for the midterm. And I will continue to post additional reviews of your quizzes and homework, and I hope to have all that out to you before we leave for break at the end of the week. So have a great day, and we'll talk to you again sometime very soon. But that's Unit 5. Thanks a lot. Bye-bye.